interest rates are higher. And with higher interest rates, that means that the money that you make on idle cash should be much higher as well. Today, we're breaking down two of the most common savings vehicles to maximize interest on cash: a high yield savings account and a money market fund. You don't want to miss today's episode. How you doing, guys? My name is John Boyd. I'm a certified financial planner, and I'm the founder and lead wealth advisor at Modern Wealth. If you like today's content, be sure to hit that like and subscribe button and share it with a friend. So with the interest rates higher, there is a potential to earn a lot more interest on your cash if you shift it away from a traditional bank. Even with rates significantly higher, most banks don't pay you a whole lot of interest. So if you have cash laying around in a traditional checking or savings account, it's extremely likely that you're earning far less than 1%, despite the effective Fed funds rate being well over 5%. Two very popular ways to ensure that your interest on cash lying around is more on par with that Fed funds rate is by shifting cash over to a high yield savings account or by utilizing a money market fund. So let's start with a high yield savings account. A high yield savings account at the end of the day is really just a standard savings account that just pays a much higher interest rate. I mean that's it. High yield savings accounts are typically associated with online institutions. It's one reason why these banks pay much higher interest. It's because they don't have the typical overhead costs that normal banks do, like brick and mortar branches nationwide. And so as a result, they can pay out more interest and pass the savings on to you. How much interest are we talking here? So the average interest rate on a savings account as of the recording of this video, which is in October of 2023, is around 0.5%. And the effective Fed funds rate is at 5.33%. In this interest rate environment, it is not uncommon to see a high yield savings account bank pay their clients over 4%. So if you have all your money sitting at a traditional bank, I would at a minimum set up a high yield savings account because it's a no-brainer for several different reasons. Number one, obviously the interest rate is much higher. Number two, you still get FDIC insurance. The third big reason why you'd want to set up a high yield savings account is that you get to experience the power of compound interest. When you look at those charts that say if you put in $100 a week for a bajillion weeks in a row and assume you get a 5% rate of return, you end up with $1 million. You know those charts that I'm talking about, right? That illustrates compound interest, and you get to experience it with a high yield savings account, because these accounts generally compound monthly or even daily in many cases. The fourth reason why a high yield savings account at a minimum is a no-brainer is that you don't have to deal with any fancy or complicated investments, right? I mean, it is super straightforward. You don't need to place any trades. You don't need to open up a brokerage account. It is super straightforward. You put your money in the account and you get the interest. It is that straightforward. Really, the only downside of setting up a high yield savings account is the fact that you have to deal with, in many cases, an online institution, which some people are more old school and they like the idea of having branches all over the place. The other big downside is that these banks oftentimes will have teaser rates. So sometimes the teaser rate might be at 4.7%. And then after a period of time, it ends up dropping down to 4 or even below 4%. So you got to watch out for that. Now, on the flip side of this, you're probably wondering, well, shoot, if the effective funds rate is at 5.33%, I want that. I don't want 4 or 4.5%. How do I get that higher rate so that my interest rate is well into the 5s? That's where a money market fund could help bridge that gap. So a money market fund is a basket of high quality short-term debt. Generally, a money market fund is going to be made up of things like T-bills, which are issued by the US government, commercial paper, which is short-term debt issued by corporations, repurchase agreements or repos. These are short-term loans for which T-bills and other government securities are used as collateral, and government agency securities. So these are short-term securities other than T-bills issued by the US government. So super safe, high quality, and with a focus on maintaining a net asset value of $1. So what that means is that when you put money in a money market fund, you aren't going to be seeing the price of the fund move daily. So you put $10,000 into a money market fund, a couple days later, you're going to see that it's worth $10,000, assuming that you haven't reinvested any interest. Money market funds historically have been the go-to cash equivalent vehicle for large institutions and high net worth individuals, But over time, they've really been democratized so that the everyday investor can get access to them. So here's a couple different reasons why money market funds are so powerful. Number one, the interest rate is much more on par with the Fed funds rate. With the effective rate at 5.33% as of the recording of this video, it would not be surprising to see a money market fund at 5.2%. And then when you factor in the compound interest, which generally is monthly for a money market fund, the yield ends up being even higher. Number two, you can invest in different types of money market funds. So let's say you're someone in a very high tax bracket and the taxes that you pay is going to eat into half the interest that you earn. Well, maybe you invest in a muni-based money market fund that is tax exempt on the federal level. Maybe you live in a high tax state like California and you invest in a treasury-based money market fund that is exempt from taxes at the state level. So a lot more tax control when you use money market funds. The third reason why you'd want to go with a money market fund is that money market funds are issued by some of the largest asset managers, not just in the United States, but in the world. So if you don't like the fact that a high yield savings account is at some online bank you haven't heard of, many of these money market funds are with asset managers with trillions, not billions, trillions in assets under management. So if you're hearing all this and you're thinking, why would I not invest in a money market fund? That sounds way better than a high yield savings account. Here are some of the arguments against money market funds. Number one, you technically don't have any FDIC insurance on the money that goes into a money market fund. Number two, in the most technical sense, a money market fund could lose money. This is called breaking the buck. Remember how I told you it maintains a dollar for dollar net asset value. You put $10,000 in, you should be able to get $10,000 out. Well, in 2008, one money market fund that was out there was overexposed to Lehman Brothers debt. And when Lehman Brothers declared bankruptcy, that caused the net asset value of the fund to drop from $1 to 97 cents. And when that happened, it scared the baloney out of everyone who had money in that fund. And so everyone rushed to the exits. And when that happened, the fund had to essentially shut their doors and tell people you're going to have to wait to get your money out or else this fund is going to explode. And so people were essentially locked out of the fund. They couldn't get their money. Now, what ended up happening over time is that investors were largely made whole, but it scared everyone. And so since then, there's been much more strict regulations around money market funds to prevent this from ever happening again. The third reason why someone would not want to invest in a money market fund is that it generally takes a little bit of work. Some institutions will automatically sweep your money into a money market fund without you even realizing it. But many institutions, if you want to invest in a money market fund, you have to manually do it. You have to actually place a trade to put money into the fund. And then when you need money out, you have to place a trade to get the money out and then it has to settle, right? It's not like a bank account where you can just log into your phone and transfer money from point A to point B. Now, with all this being said, which one should you pick? A high yield savings account or a money market fund? In my opinion, as long as you don't mind not having the FDIC insurance, I think a money market fund could be a great option. Because if you truly want to have government backing in your investment, then you could invest in a treasury-based money market fund. Money market fund yields are generally much higher. And then on top of that, you can be really creative with the tax planning. Now, with all that being said, if you still are on the fence about money market funds or that 2008 story just scares you too much, I get it. If that's the case, just stick with a high yield savings account. It's certainly better than nothing, and it's certainly better than the national average in the vast majority of cases. I hope you enjoyed today's video. If you need help optimizing your investments and financial plan, reach out to us at www.modernwealth.com. That's modern spelt with no vowels, wealth.com. Be sure to hit that like and subscribe button, and I will see you next time.